What's up everyone, welcome to Iman's Hado. Today we'll be looking at my current portfolio and how I will be allocating $2,900 into that portfolio. Without further ado, let's get started. Alright, so here's my portfolio. 10 shares of AT&t, 10 shares of Atlantic Yield. Atlantic Yield is a solar company. As you can see, the IPO went well, they dropped in price, rode back up, but in the past, little while, the trajectory is a slight upward trend. Their financials are good. Excuse the loud click-clacketing. So if we go to their website, Atlantic Yield, and we go to investors, and we go to their, let's just check their first quarter then. Energy companies are they're not really cyclical. They're kind of like utilities. So, okay, by the way, when you go to any company's thing and they have these key messages, they're not bullshitting you, They're giving you legit they're not bullshitting you, but you're gonna have to look deeper. You have to look deeper. You have to learn. You have to know about the industry, what the industry is about financially, how the company is doing financially. Are they diversified? Like with an energy company, for example, a solar energy company, do they have plants in different countries? What are the rates in those different countries, different continents? Atlantic Yield for me hits a lot of the priorities. They have. Let's see if we can find it here. Yeah, I don't know. No, they don't have it here, but they're diversified globally. They're mostly geez, I can't even speak. They're mostly a solar company. As you can see here, their revenues are up. Their EBITDA, what is this? Earnings before tax somethings. It's just another way to look at kind of like EPS, but it's different. It's like earnings per something. Is up 9%. CAFD of cash. What is a CFAFD? I don't even know what CFAFD is, honestly. Their dividend was 32 cents per share, and it increased. And Algonquin, kind of like a renewable energy utilities company, is partnering up with Atlantic Yield. They're actually on my watch list also. So this is Atlantic Yield. Feel free to check them out. If you don't like them, you don't like them. They're a pretty good diversified company in solar and as you can see here, solar, natural gas, they do water water treatment, and they also have some slight utilities. So they're I think a very solid company. I think very recently their credit rating just got upgraded to like a triple B. So I think that's all good, fine and dandy. You should look at this yourself. Just type in Atlantic Yield and it'll come up. So I've got 10 shares of that. As you can see, the portfolio is up. I started the account in July 11th, so it's about a little under a month old. AT&T, AT&T kind of goes without being said. It's kind of like a divisive stock, I guess, because their share price has dropped tremendously. They acquired Time Warner, and people whenever a company acquires stuff, it seems to me like people are always kind of like, what's gonna happen? But I don't understand why. I bought these 10 shares at $31.60. That's their pre-Time Warner acquisition stock price. That doesn't even make sense. Their debt ratio is at 42% per their market cap, which is a lot, but it's manageable. They're a dividend aristocrat. They pay a strong yield of it's actually 6%, $2 per share. This I think is a great value because people are scared of what's of AT&T right now. That's fine with me, but I was looking at it down here. It was this past week actually, or maybe it was this past month, but I was looking at AT&T right here, and I was like, yeah, okay, oh no, it's right here. I was like, okay, I'm gonna buy it 31. I'm gonna wait for it to drop, right? And it shot up it shot up Was it right here? Yeah, I think somewhere around here. It was like 31 something. Yeah, I don't remember. But it was cheap. I was under $32. It shot up, and I was like, oh, okay, I'm not a day trader. Just buy it now and hold. Yeah, so that's AT&T for you. I like their company. When I get back to what I'll be doing with my $2,900, how I'll be allocating that. I'll share that after I give you my stock picks. BEP is Brookfield Energy Partners, renewable partners. Sorry, but I only have one share of them. I've got to learn more about their company. They're also a renewable energy company. The reason why I like renewable energy companies is that demand for renewables, so this is, I'm talking like as an industry, is only going to go up over time. Depending on what administration in different countries, like most countries are prioritizing renewable energies over things like oil and coal. Obviously, I mean, these are long-term trajectories that anybody can really understand, right? Renewable energies on the up, right? Combined with the fact that they're basically utility companies. Well, this one specifically is a utility company, but they own a, see, they're an MLP, but they basically own, they're kind of like, their corporate structure is a little bit different. I'm not an expert. I'm not going to try to like buff it up, but their corporate structure kind of goes like this. So let's say Brookfield is actually, this is actually one of their subsidiaries, but Brookfield, I think it's Brookfield Asset Management owns a bunch of different, how do I say, companies, MLPs, Invescos, stuff like that. And they manage it financially. So that's what this is what Brookfield Energy Renewable Partners Ltd, whatever it is. But a lot of these kind of MLP renewable energy stuff, kind of, they don't really have a good track record, honestly. A lot of them went out of business, but this one from Brookfield, they do a really good job managing their sub companies, whatever the hell how it all works. But it's a good, I think it's a great stock pick. I mean, let's go to their website. Yeah, the reason why I'm going through this is it's always important to. I personally don't even look at the quarterly earnings. I mostly look at the yearlies. But yeah, not as pretty as Atlantica yields, huh? But let's see, total generation, actual generation, 6 months and 2017. Okay, so they're producing more energy on average. Yeah, they're producing more energy on average. That's awesome. Yep. Long-term average generation funds from operations per unit. Since it's an MLP, you're a unit holder. You don't really have to pay taxes on any of this stuff. Net loss. So yeah. Anyways, I think it's an awesome company. I like the structure. I like the dividend yield. I like the way it's managed. I like the long-term trajectory of the stock price. I think it's at a reasonable price for a 5% yield. I like renewable energies. It's managed good. The financials are good. It's growing as a company. They're producing more energy, as you can see here, is what they're selling. So I'm really, really happy with this. I will be upgrading. You know what? Yeah. We won't say yet. I'll tell you the allocations later. So EPD, I don't even have to look. I listened to the earnings call like a week ago, but EPD is like they're basically a pipeline. They're a midstream pipeline company. I think they pump mostly natural gas, and petrochemicals and stuff. So they're basically just, and I think they also do some refining. So they get hit when oil goes down. Look at down here. But for me, I like energy. I like utilities. Well, mostly just energy. But I feel like I had to pick an oil-based company, just because it's if I wanted to have the energy sector, it's not complete without oil. But their financials are good. Their pipelines aren't at peak efficiency yet, and they can get it up there. What were they saying on the conference call? Yeah, basically they're on the upward trajectory is what they were saying. They were talking about, quarterly crappy dappy, but they're finding more sellers for their services. They're growing their revenues and all that good stuff. GIS is General Mills. I like General Mills because it's one of those, it's a cereal brand pretty much, and some other stuff. They have grocery brand is probably a better way to put it, as you can see here, grocery. But yeah, General Mills stock price really took a hit. I bought one share at 47. I'm gonna buy as long as it's under $50. So hopefully it stays under 50 whenever I get my $2,900. Yeah, stock price going down. I think they actually had negative income. I think they were overpriced. Around here, they're way overpriced. This didn't make sense, and there was a market correction. There was some kind of shaky earnings reports, and then combine that with it being overpriced, it was like a catalyst of just, and people get scared when people kind of are thinking is this stock really worth it? And then they hear bad news, they just dump. So I think it's at a pretty good price now. Best price is probably going to be as long as we have a really strong market. As for these stocks here, I want to have at least 25 shares of AT&T. I'm thinking 20 shares of Atlantic Yield, 10 shares of Brookfield Energy Partners, Renewable Partners, whatever the heck it is, 10 shares of Enterprise Productions, EPD. I want to have $500 worth, basically 10 shares of General Mills. But that leads me to, so if we do, or I'm gonna keep $400 for other stuff. But if we do this, so 25 shares is about $500. $450 worth of General Mills, $200 worth of Atlantic Yield, $270 worth of BEP, and then $150 worth of EPD. Right, I might not go full 10 shares. Maybe I'll do 50 shares of Atlantic Yield, because I want to add more energy stocks, and I kind of want to be a little bit spread out with them. Like if I'm just with telecoms, I can go deep. With consumer non-cyclical, I can go deep. But yeah, $930 left, right? So I was watching Qualcomm. I was planning on buying Qualcomm, but then it jumped up in price like the past not even that long. Look, I was looking at it around here, $60. Or wait, where is it? Yeah, I was looking at it here, 56, and then just jumped up to $64. It still has a nice dividend yield, but it's basically a telecommunications company. They lease. Basically, it's if you want to have 4G, it's who am I going to get 4G from? I don't have any companies that can do the technology, and then they'll basically come in with a proprietary CDMA technology, and they'll build your entire country their telecommunications network, and they'll just collect they basically sell their patents. Right, when they have problems sometimes, they don't have problems other times. Seagate, they have a good dividend yield. It's a hardware company, a storage company. Unilever, Southern Company. This is just what's on my watch list. Apple. I was planning on buying Apple when it was at $180 when I was looking at it last. So yeah, right around here, 180. Oh, more like 190. But wow, that's crazy cool. I want to buy Apple, but it's just not the time yet. Algonquin, I want to buy Algonquin. Pfizer, Cardinal Hall, just looking. Shaw, a telecommunications company that pays a 4% dividend yield. That they're Canadian, they pay monthly. Verizon, to kind of diversify the telecommunication, maybe Intel, $50 per share. It's a nice tech stock. I know they've been losing out to AMD. For example, my computer, I don't have an Intel chip in there. I have an AMD Ryzen, so Intel, I don't know. They're kind of. They win in some markets. If I was building I built this as a gaming PC, but now it's mostly a work PC. But if I was going to build it again, I'd probably go Intel, but still, the Ryzen stuff is beating them dollar per dollar. But here we go. IBM, I'm thinking about IBM. They're the only big cloud computing / artificial intelligence company that pays a solid dividend. My rule right now is I don't want anything that doesn't pay a dividend. Yet Starbucks is down there. So I like IBM a lot. Peggy, this is an interesting one. So out of all of those, right, this is what I'm definitely thinking about adding. Pattern Energy. So it's an Invesco, which has a very similar structure as an MLP. Basically, there was like 6 or 7 or maybe 8 Invescos that came out around the same time, like 2013, and all of them died except for Pattern Energy and like Terra Power or whatever. But Pattern Energy is pretty awesome. They like most energy companies that are worth their salt. Basically, what they do is anyways, let me explain what an Invesco is. It's kind of like, imagine like, so there's MLPs, there's RITs, and there's Invescos. Think of like an Invesco is kind of like a utility MLP is how I'm gonna put it. But don't take my word for it. Do your own research on what an Invesco is and an MLP is and all that good stuff. But basically, they have to pay most of their profits to the shareholders, but they can choose the amount that they choose to give to the shareholders. So I think an MLP, they have to do like 90% or something, but an Invesco can choose how much they want. The one problem is no, I think that's with RITs, but there's always a problem with these types of companies is they're pretty volatile. You know, as you can see, think, why did the share price drop to 13? Were people scared about Invescos? It's not a very big financial industry, you know, this Invesco stuff. A lot of it, you know, didn't too hot, but yeah. Anyways, I like Pattern Energy. We can look at them real quick. I like them because that big fat dividend yield is what I liked, and when I see that big fat dividend yield, I think, man, this company must be messed up, right? But then I was learning more about it. I was okay, so it's this thing called an Invesco. It's an Invesco. So I was learning about Invesco. I was like, okay. I was like, okay, it's an Invesco. I like that. You don't have to pay the taxes on it because you're a unit holder. I like that even more. But the problem is with Donald Trump in charge. Okay, let me just start off the bat. I like my boy Trump. I wasn't able to vote in 2017, but I don't have anything against the guy. A lot of people really don't like him, but I mean, he's fine in my book. We'll see who the Democrats can run against him. But unfortunately for renewables, Donald Trump being in charge we don't really know what's kind of happening, I guess. You know, with Obama, he's like really gung-ho, like, oh yeah, renewable energies, that's stuff, man. It's like, you know, like, but with Trump, it's kind of more like, he doesn't really seem to be very interested. I think it might be because of the coal lobby and his base and stuff, but without any further ado, let's just start looking at the financials, because this company is actually diversified in actually, I think if we go here to learn, we can see can you go there? Okay, whatever. If we go to learn and we go to their portfolio, they have facilities all across the world. Yes, they're based mostly in the United States, as you can see, heavily within the United States. But look, as you can also see, they have assets in Canada. They have assets in Japan. They have assets in, I think they have one in Chile, or they might have sold this one for a mega profit or something. But as you can see, I think they also have some in Mexico. I don't know why it's not showing. I don't understand why it's not showing, because they do have assets in Mexico. But yeah, see, as you can see, they're starting to diversify into other countries and stuff. So I like that. It's not as much as Pattern. Pattern's like, we have Spain, we have Algeria, we have the United States, we have Canada, we have Chile, we have XYZ, but yeah, it's a cool company. I like them a lot. So as you can see, they're not like, let's be real now, most of their holdings are in the United States, but I don't have a problem with that, you know, as long as they're attempting to expand their portfolio over the long run and diversify through location. Because I don't want like some new president to be like, I hate renewables or something, or you know, or some new president of a different country or prime minister of this or that. But anyways, financials. Anyways, basically Pattern's healthy financially. Here we go. 13D. Let's go to the annual filings. Alright, here we go, 10Ks. There we go. This is what we've really been looking for. So here we go. a lot of mumbo jumbo, and it lists like, you know, what the problems are, what's going on. It's a really good, robust 10K, which all 10Ks are. But if you want to learn more about the industry, honestly, just read because every single let me see here. So a lot of every 10K, or what is it, 10K or 10Q or whatever, but a lot of these will list like the risks of what's going on. But I think this is just their balance sheet. Yeah, but anyways, they're healthy financially is the gist. But that can change, you know, along with anything. So another one I've been looking at heavily is the Royal Bank of Canada. Royal Bank of Canada they had a little bit of a correction here, and I think they're better priced, and you know, companies like this all are constantly growing their, look at it like, pretend like this is like I'm growing my earnings, I'm growing my earnings, I'm growing my earnings, right? But if I grow my earnings, right, let's say this is like 2019 or whatever, 2020, and you bought up here, I mean, your buy price is the same as like whatever this EPS was in the originals, in the original, right? It takes you forever to earn that back. Maybe the stock trades at a premium, right? But in general, you want to buy on these dips if the company is financially healthy. This was just a correction because it was overpriced. Has a 3.4 dividend yield, and it's the Royal Bank of Canada. Do I even need to say anything? These guys have been so reliable when it comes to paying their dividend, and they've been growing it and growing it and growing it. So I think this is like a Class A company, but and it's a financial sector, and I don't have anything in the financial sector. I mean, yeah, you could say BEP's financial, but no. If I bought Brookfield, maybe that would be financial, but no, I don't have anything in the financial section. One thing I've also been thinking about adding is Starbucks. Huge growth company. Look at this, like their stock price just like, you wanna know why? Because it was over freaking valued. That's why. And thank God they had a correction, because now I'm thinking about buying, and I like it. It only has a 1.86 dividend yield, but what am I trying to say? Gosh, I'm getting a headache. But their dividend growth is awesome. It's just absolutely awesome. And their growth over time, like if you look back to like 2000, just it's insane. It's like buying Apple, but it pays a better dividend. Actually, I don't think it even does, but just a good opportunity to buy Starbucks because the capital appreciation and the dividend. I'm also thinking about other stuff, you know, like maybe buying SPHD. It's like an ETF. Yeah, it's basically flat 4% because they charge a 0.3% fee. And I'm also thinking about, what if I just dropped all my money in this, right? Just, it's low volatility, pretty much follows the market. But it's inefficient, right? Because the market is inefficient. There's always inefficiencies in the market. I want to buy the inefficiencies. I want to learn more about investing. And if I just buy an ETF, it's a good ETF, but I don't really feel like I'm taking control over my portfolio. But that being said, I think it would be a great defensive play, you know? Not even a defensive play, just like a core that my portfolio can kind of rock around and tie myself to the market, you know? Because if I'm just investing in like telecommunications, renewable energies, the odd consumer non-cyclical, like, yeah, I'm investing in different industries, and maybe if I get a tech stock, or I get an insurance stock, and I pick up a restaurant with Starbucks, I pick up a medical company with AbbVie, that's all fine and dandy. But those ETFs are really, really, really well diversified, just because they have to be most of the time. But yeah, that's another thing I've been thinking about. But as for the allocation goes, this I'm thinking $500 to Starbucks. So here we go. We pull out the calculator. I'm thinking $500 to Starbucks leaves me with $430, right? I'm thinking I could buy Peggy. It's an MLP. I don't have to pay taxes. That's awesome. Convanta Energy is awesome too. Their They're basically like a waste management company that turns waste into energy, and I think that's freaking awesome. It is considered a fossil fuel for some reason, but I think that's freaking sick. So I could maybe 10 shares, right? I would like to buy Starbucks, honestly. I think Starbucks, I know it breaks the rules of the portfolio of, oh, you have to buy stocks with dividends, but I wanted to buy Apple, because Apple pays a dividend. It's a growth company. I just don't want. I don't want to buy Apple at $210. I know that people said that maybe whenever it was worth like $50, or like my uncle was telling me for my cousin's birthday they had like $1,000 from like birthday presents, and they're thinking, oh, what if we just bought Apple stock? It was like $80 back then. Now it's worth $210. Like, there's honestly like no better time to invest in Apple than now and just start dollar cost averaging. But I mean, there's other companies out there that are freaking awesome and they're freaking amazing, and I think Facebook is in a very, very, very attractive price, like a very attractive price. Just look at that growth. I mean, this isn't a 5-year period. And keep in mind, they have like no debt. They own Instagram. They own, what's it called, WhatsApp. You know, that's just insane. Like the amount of freaking like sway this company. Shoot, they have more freaking people. They have more freaking people on Facebook than the freaking China has even human beings. You know, it's insane. Like, it's just a profit like generating machine. But that being said, it's not really a profit generating machine for me because they don't pay a dividend. But you know, come on, you can't be such a stickler all the time and just, you know, $177 out of a $3,000 or $3,250 portfolio. That's like nothing. That's like 90+% of the portfolio. Like 95+% of the portfolio is straight up dividends. You know. But if I break the mold, maybe I want to break the mold twice. And maybe as a growth stock alternative, I can pick up AAPL. Anyways, what I'm saying is not investment advice. Okay, so don't take it as advice. This is just what I'm thinking about, what I'm doing for myself. Don't like take anything I'm saying as like fact, because I'm just an idiot who has money and is throwing it at stocks. So keep that in mind, and make your own decisions and seek a financial advisor, because they actually do know what they're talking about. Anyways, what do you guys think about the portfolio? You probably won't see it until I allocate the money. I allocate my my lump sum, and that's pretty cool that I have that lump sum, and it's a blessing for sure. Because that lump sum is almost 4 times, it's like 2.5 times my portfolio, and that's insane. Can you imagine just increasing your principal by 2.5 times? And that's why it's so important to start investing now, because like I gotta build my little army of dollars, is what I've heard before. Anyways, that's gonna be the end of it. Thank you very, very much for watching. I'm out.